Today, let's take a look at how arbitrage mutual fund returns have reduced over the last few months because of a reduction in arbitrage opportunities. Now, there is an index that tracks the price difference between buying equities and selling equivalent equity futures and profiting off the difference, which is essentially the core idea behind an equity arbitrage mutual fund. And this price has been falling. The price difference has been falling for the past few weeks, and in fact, the last 13-week return for this fund, the absolute return for this fund has been negative. So it's been falling down. So it's a drying up of arbitrage opportunities because there's not enough players in the futures market, especially the foreign investors. There are not enough players there, and because of that, the futures price has fallen below the spot price, and therefore the spread, that is the price difference between the future price and the spot market price, that is usually positive, but because there's not enough players around, the spread has actually turned negative. This is not the first time it happens. It happens whenever there is a financial crisis. It occurred in 2008 after the 2008 crash, and now it has happened again. And whenever this happens, mutual funds consider stopping inflows for a short while into arbitrage funds because it affects existing investors, and we don't want new people coming in and getting poor returns. So they did that in July 2009, and briefly in March and April 2020, a couple of AMCs, Tata and ICICI, did that. And after that, the arbitrage index has recovered for the past month or so. It's turned positive for the past month or so. This happens. Now, what you see in this picture is the Kotak equity arbitrage NAV, that's the white line, and the orange line is the Nifty 50 arbitrage index. You can see that over the past few months, the arbitrage index has been falling down, and with the Kotak, the NAV kept moving up for a while, but then the rate at which it moved up slowed down significantly. And the only reason for this difference is because of the fact that the Kotak or any arbitrage can hold up to 35% in bonds, and that's why this difference is there. The bonds have been holding up the portfolio for the last few months. Of course, these bonds are short-term bonds, and even there in that segment, in the short-term segment, the returns have gone lower, and the yields have dropped, and therefore those returns are also kind of muted. So this is similar to a reinvestment risk that's seen in an overnight mutual fund, and that's linked in the article. You can have a look at that. I have tabulated the trailing returns of ICICI arbitrage index and Kotak arbitrage index along with the Nifty arbitrage index. You can see here the last 2-month return for the arbitrage index is negative, 3-month is negative, 10-week is negative, 11-week, 12-week, and up to 13 weeks is negative. But the arbitrage funds have delivered a little bit positive return because of the bonds that they are managing in the portfolio. So what this means is that you should not use arbitrage funds to get returns for a very short while because they can be risky. But if you're using it for the long term, above 1 year, these things will sort of smoothen out. Of course, it would impact returns. Returns may be a little lower, but then but that's the risk that you take with arbitrage. But I don't think you will get it will lead to losses above 1 year. It can lead to losses for a month or maybe up to a quarter or so, and that's natural in the case of, that has happened before in the case of arbitrage funds. Now, I have been like I mentioned, I use arbitrage funds for 2 reasons. One, it's part of my emergency fund is there, and it is also part of my son's future goal. It's part of I use it as a kind of a debt instrument. And the emergency cash after one withdrawal, it's just grown about 6.5% over the last 4 years or so. And I'm just pointing it out. It's not just to show you the returns. I'm not saying that it matters for an emergency fund. It doesn't matter. And for the son's future goal, I rebalanced it twice in 2017 and in 2019 as well. And because of that, the return now is about 6.3%. Of course, it should probably drop down a little bit, but that's fine. I'm not going to do anything about it. It's not a big deal. So of course, what will happen now is people will stop investing in arbitrage funds because they'll see the returns drop. Some people will also pull out, and therefore, because of that, that should kind of compensate for the lack of arbitrage opportunities. So it's a good thing in my opinion. So existing investors who have a long term, kind of a long term meaning not just a few months, beyond that, long 1 year and above. They can hold on. I don't see any reason for them to panic or anything. Only caveat is that mutual fund investors should have a look at the fact sheet and find out the bond portfolio, because if the returns drop, to attract investors, mutual funds can take on credit risk, and they may and that can cause problems like we saw. So keep an eye on the fact sheet. As long as it's fine, the quality is fine, it's not a big deal. So that's what I wanted to say in this video. Catch you later. Bye bye.